Welcome back to our special Inside China Indianomics. We've been discussing with the China expert, Professor Eswar Prasad, to get a 360-degree perspective on how the various events inside and outside China are likely to impact economic growth there. Professor Prasad, thank you very much for your patience and for waiting on. I wanted to know how the Renminbi might move. Your book on the Renminbi itself has become very famous. Do you think China will allow the Renminbi to depreciate even more simply because it will give it an export advantage? What's your best guess? Does it go towards 8 towards the dollar, or does it go below 7 towards the dollar?
Now, China made a commitment a few years ago to allowing the renminbi's value to be set largely by market forces, and we are seeing a real test of that commitment. And so far, it does seem to have held up by and large. The renminbi has been depreciating quite significantly against the dollar, and like many other currencies, including the Indian rupee, the depreciation on a trade-weighted basis is much smaller because there are many other trading partners of China whose currencies have depreciated even more relative to the dollar. But the currency that matters in international finance, of course, is still the dollar. And for China, this is a concern. And right now, we are beginning to see less capital flowing in and some capital from domestic investors seeming to flow out. And that's partly because the stock market and the economy have not been doing well, but also it's very clear which way the political winds are blowing. So I suspect that there is some money from the elite classes, the economic and political elites, that may be leaving China in search of safer places. So for China, this is a slightly complicated moment because while some degree of renminbi depreciation might be useful in terms of supporting export growth, the amount of export demand in the rest of the world is actually quite limited at the moment, given that the rest of the world is facing a fairly difficult set of economic circumstances. Now, Chinese exports have not done too badly in the last 3 or 4 quarters, although we are beginning to see some weakening in terms of export growth. So China now faces this difficult situation where a depreciating renminbi doesn't give them a huge benefit in terms of additional export growth, but could set off instability in terms of capital flows. Because if people anticipate more depreciation, that could lead to even more capital outflows, less capital coming in. So you set off a currency depreciation, capital outflow spiral. So I think we might see further depreciation on a very controlled basis, where China tests out the grounds, tries to see if a move of the renminbi in a weaker direction leads to more capital outflows, leads to more destabilizing effects. And if not, I think we might well see some additional depreciation. So far, we haven't seen any capital control measures to limit the amount of money going out of the economy, although they have started putting some restrictions on banks' ability to borrow abroad in foreign currencies and so on. And I suspect they will rely on that tool as they have in the past if the pressures on the renminbi become more severe.
I'm tempted to ask you about the Fed tightening as well, but I don't think I have that much time. Let me stick to the China issue. What does all this mean for India, Professor Prasad? The fact that there is an escalation of tension between US and China, the fact that China itself, political economy-wise, is becoming a bit suspect or a dangerous game for foreigners, does that make India more attractive?
Yeah, so let me stick with the economic aspects of that question, Lata. It's clear that there is an opportunity here for India in terms of becoming an important part of global supply chains, and in terms of becoming a supplier of certain products where China has tended to dominate the market so far. And I've been quite encouraged, to tell you the truth, to see that unlike in previous episodes where the rupee depreciated, but we didn't see much of an effect in terms of India's export growth, we are seeing Indian exports doing somewhat better than they used to in the past episodes of rupee depreciation. And more importantly, we are seeing some high technology exports beginning to pick up. So they're not at a level yet where they would make a huge impact on India's growth. But I think this can be the foundation for India becoming a much more important part of global supply chains and moving up the value-added chain, moving into higher technology sectors itself. I also see India as becoming a potentially more interesting, attractive destination for foreign investors, because we do have fairly deep liquid and well-regulated financial markets, and especially compared to a market like China, where clearly there is going to be much more volatility down the road. There is a lot more uncertainty about government policies. I think this is the time when India, if it can show that it has stability in terms of economic policies and in terms of the overall policy framework, as it becomes more conducive to the private sector investors, to private enterprise more broadly, we could pull in a lot more investment in terms of both foreign direct investment and portfolio investment.
A last quick question. I'm not being allowed by my producer, but I am going to take the liberty. You know, we get two different reactions. There are one set of foreigners who say, or especially Americans, who say that China is a dirty word and we won't be allowed to invest there anymore. And therefore, we will look for other destinations, India attractive. And the other set which says that, China is so important that what we will invest outside will be a very small percentage of what's already tied to China. Which is the truth?
So there is going to be some passive money that goes into China still. It's still a part of important equity and bond indexes. There is going to be some money made in China still through very selective investment strategies. But it's going to be terrain that is attractive to investors who are looking for decent yields, but with very high risk, both economic, political, and of course the geopolitical risk aspects as well. So I don't think we will see that much active money going into China, and we're looking for other destinations, especially because in the coming years, we're going to see economic policies in China take a turn. That is going to be much more, as we discussed, state-dominated, and that is going to make it harder for private enterprises to thrive. It's not that we will see a huge pullback of money from China, but certainly this is going to make investors take a very close second look at any investments they make in China, and possibly cause them to pull back and look at other markets.
All that is sounding like Advantage India. Thank you very much, Professor Prasad, for giving us additional understanding of the myriad changes that are happening inside China and with respect to China. Thank you very much for joining us on this edition of Indianomics.